We ensure that you, your family, your business and property are fully protected against the uncertain. Furthermore, we want you, our customer, to have a full understanding of the coverage and protection you have with us. Simplicity is at the core of not only our name but our business. We strive to simplify and streamline the process to obtain quotes, purchase and maintain your policy. As longtime members of communities in Florida, our staff understand the unique risk characteristics of the state when it comes to protecting your property, family, and future. Our team takes a specialized approach to help you select the coverages you need at a price you can afford. Insurance in the United States refers to the market for risk in the United States, the world's largest insurance market by premium volume. One of the $5.380 trillion of gross premiums written worldwide in 2019, $1.548 trillion, 28.8%, were written in the United States. 1. Insurance, generally, is a contract in which the insurer agrees to compensate or indemnify another party, the insured, the policyholder or a beneficiary, for specified loss or damage to a specified thing, for example, an item, property or life, from certain perils or risks in exchange for a fee, the insurance premium. 2. For example, a property insurance company may agree to bear the risk that a particular piece of property, for example, a car or a house, may suffer a specific type or types of damage or loss during a certain period of time in exchange for a fee from the policyholder who would otherwise be responsible for that damage or loss. That agreement takes the form of an insurance policy. The first insurance company in the United States underwrote fire insurance and was formed in Charleston, South Carolina, in 1735. 4. In 1752, Benjamin Franklin helped form a mutual insurance company called the Philadelphia Contribution Ship, which is the nation's oldest insurance carrier still in operation. 5. 6. Franklin's company was the first to make contributions toward fire prevention. Not only did his company warn against certain fire hazards, it refused to insure certain buildings where the risk of fire was too great, such as all wooden houses. The first stock insurance company formed in the United States was the Insurance Company of North America in 1792. 7. Massachusetts enacted the first state law requiring insurance companies to maintain adequate reserves in 1837. Formal regulation of the insurance industry began in earnest when the first state commissioner of insurance was appointed in New Hampshire in 1851. In 1859, the state of New York appointed its own commissioner of insurance and created a state insurance department to move towards more comprehensive regulation of insurance at the state level. Insurance and the insurance industry has grown, diversified and developed significantly ever since. Insurance companies were, in large part, prohibited from writing more than one line of insurance until laws began to permit multi-line charters in the 1950s. From an industry dominated by small, local, single-line mutual companies and member societies, the business of insurance has grown increasingly towards multi-line, multi-state and even multinational insurance conglomerates and holding companies. State-based insurance regulatory system. Historically, the insurance industry in the United States was regulated almost exclusively by the individual state governments. The first state commissioner of insurance was appointed in New Hampshire in 1851, and the state-based insurance regulatory system grew as quickly as the insurance industry itself. 9. Prior to this period, insurance was primarily regulated by corporate charter, state statutory law and de facto regulation by the courts and judicial decisions. Under the state-based insurance regulation system, each state operates independently to regulate their own insurance markets, typically through a state department of insurance or division of insurance. Stretching back as far as the Paul v. Virginia case in 1869, challenges to the state-based insurance regulatory system have risen from various groups, both within and without the insurance industry. The state regulatory system has been described as cumbersome, redundant, confusing and costly. The United States Supreme Court found in the 1944 case of United States v. Southeastern Underwriters Association that the business of insurance was subject to federal regulation under the Commerce Clause of the U.S. Constitution. 13. The United States Congress, however, responded almost immediately with the Mccarran Ferguson Act in 1945. 14. The Mccarran Ferguson Act specifically provides that the regulation of the business of insurance by the state governments is in the public interest. Further, the Act states that no federal law should be construed to invalidate, impair or supersede any law enacted by any state government for the purpose of regulating the business of insurance, unless the federal law specifically relates to the business of insurance. A wave of insurance company insolvencies in the 1980s sparked a renewed interest in federal insurance regulation, including new legislation for a dual state and federal system of insurance solvency regulation. 16. In response, the National Association of Insurance Commissioners, NAIC, adopted several model reforms for state insurance regulation, including risk-based capital requirements, financial regulation accreditation standards, and an initiative to codify accounting principles. As more and more states enacted versions of these model reforms into law, the pressure for federal reform of insurance regulation waned. 17. However, there are still significant differences between states in their systems of insurance regulation, and the cost of compliance with those systems is ultimately borne by insureds in the form of higher premiums. McKinsey & Company estimated in 2009 that the U.S. insurance industry incurs about $13 billion annually in unnecessary regulatory costs under the state-based regulatory system. The NAIC acts as a forum for the creation of model laws and regulations. Each state decides whether to pass each NAIC model law or regulation, and each state may make changes in the enactment process, but the models are widely, albeit somewhat irregularly, adopted. The NAIC also acts at the national level to advance laws and policies supported by state insurance regulators. NAIC model acts and regulations provide some degree of uniformity between states, But these models do not have the force of law and have no effect unless they are adopted by a state. They are, however, used as guides by most states, and some states adopt them with little or no change. 19. There is a long-running debate within and among states over the importance of government regulation of insurance, which is noticeable in the different titles of their state insurance regulatory agencies. In many states, insurance is regulated through a cabinet-level department because of its economic importance. In other states, insurance is regulated through a division of a larger Department of Business Regulation or Financial Services, on the grounds that elevating too many government agencies to departments leads to administrative chaos, and the better option is to maintain a clear chain of command. Federal regulation of insurance. Nevertheless, federal regulation has continued to encroach upon the state regulatory system. 16. The idea of an optional federal charter was first raised after a spate of solvency and capacity issues plagued property and casualty insurers in the 1970s. This OFC concept was to establish an elective federal regulatory scheme that insurers could opt into from the traditional state system, somewhat analogous to the dual charter regulation of banks. Although the optional federal chartering proposal was defeated in the 1970s, it became the precursor for a modern debate over optional federal chartering in the last decade. In 1979 and the early 1980s, the Federal Trade Commission attempted to regulate the insurance industry, but the Senate Commerce Committee voted unanimously to prohibit the FTC's efforts. President Jimmy Carter attempted to create an Office of Insurance Analysis in the Treasury Department, but the idea was abandoned under industry pressure. In 1979 and the early 1980s, the Federal Trade Commission attempted to regulate the insurance industry, but the Senate Commerce Committee voted unanimously to prohibit the FTC's efforts. President Jimmy Carter attempted to create an Office of Insurance Analysis in the Treasury Department, but the idea was abandoned under industry pressure. Over the past 2 decades, renewed calls for optional federal regulation of insurance companies have sounded, including the Gramm-Leach-Bliley Act in 1999, the proposed National Insurance Act in 2006, and the Patient Protection and Affordable Care Act, Obamacare, in 2010-16. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, which is touted by some as the most sweeping financial regulation overhaul since the Great Depression. The Dodd-Frank Act has significant implications for the insurance industry. Significantly, Title V have created the Federal Insurance Office, FIO, in the Department of the Treasury. The FIO is authorized to monitor all of the insurance industry and identify any gaps in the state-based regulatory system. The Dodd-Frank Act also establishes the Financial Stability Oversight Council, FSOC, which is charged with monitoring the financial services markets, including the insurance industry, to identify potential risks to the financial stability of the United States. Admitted v. surplus, an important artifact of the state-based insurance regulation system in the United States, is the dichotomy between admitted and surplus insurers. Insurers in the U.S. may be admitted, meaning that they have been formally admitted to a state's insurance market by the state insurance commissioner, and are subject to various state laws governing organization, capitalization, policy forms, rate approvals, and claims handling. Or they may be surplus, meaning that they are not admitted in a particular state but are willing to write coverage there. Surplus line insurers are supposed to underwrite only very unusual or difficult to insure risks, to prevent them from undermining each state's ability to regulate its insurance market. Although experienced insurance brokers are well aware of what risks an admitted insurer will not accept, they must document a diligent effort at actually shopping around a risk to several admitted insurers, typically 3, who will promptly reject it, before applying for coverage with a surplus line insurer. relieve insurers and brokers of that tedious and time-consuming chore, many states now maintain export lists of risks that the state insurance commissioner has already identified as having no coverage available whatsoever from any admitted insurer in the state. In turn, brokers presented by clients with those risks can immediately export them to the out-of-state surplus market and apply directly to surplus line insurers without having to first document multiple attempts to present the risk to admitted insurers. 24. However, many states have refused to establish export lists, including Florida, Illinois, and Texas. By their very nature, export lists illustrate what U.S. insurers consider to be hard to insure risks. For example, the California export list includes ambulance services, amusement parks, fireworks displays, moving a building, demolition, hot air balloons, medical billing, product recalls, sawmills, security guards, and tattoo shops, as well as particular types of insurance like employment practices, liability, and kidnap and ransom. By the Commonwealth Fund. The U.S. health system is a mix of public and private, for-profit and non-profit insurers and health care providers. The federal government provides funding for the National Medicare program for adults age 65 and older and some people with disabilities, as well as for various programs for veterans and low-income people, including Medicaid and the Children's Health Insurance Program. States manage and pay for aspects of local coverage in the safety net. Private insurance, the dominant form of coverage, is provided primarily by employers. The uninsured rate, 8.5% of the population, is down from 16% in 2010, the year that the landmark Affordable Care Act became law. Public and private insurers set their own benefit packages and cost-sharing structures within federal and state regulations. How does universal health coverage work? The United States does not have universal health insurance coverage. Nearly 92% of the population was estimated to have coverage in 2018, leaving 27.5 million people, or 8.5% of the population, uninsured. One movement towards securing the right to health care has been incremental. Employer-sponsored health insurance was introduced during the 1920s. It gained popularity after World War II when the government imposed wage controls and declared fringe benefits, such as health insurance, tax-exempt. In 2018, about 55% of the population was covered under employer-sponsored insurance. In 1965, the first public insurance programs, Medicare and Medicaid, were enacted through the Social Security Act, and others followed. Medicare. Medicare ensures a universal right to health care for persons age 65 and older. Eligible populations and the range of benefits covered have gradually expanded. In 1972, individuals under age 65 with long-term disabilities or end-stage renal disease became eligible. All beneficiaries are entitled to traditional Medicare, a fee-for-service program that provides hospital insurance, Part A, and medical insurance, Part B. Since 1973, beneficiaries have had the option to receive their coverage through either traditional Medicare or Medicare Advantage, Part C, under which people enroll in a private health maintenance organization, HMO, or managed care organization. In 2003, Part D, a voluntary outpatient prescription drug coverage option provided through private carriers, was added to Medicare coverage. Medicaid. The Medicaid program first gave states the option to receive federal matching funding for providing healthcare services to low-income families, the blind, and individuals with disabilities. Coverage was gradually made mandatory for low-income pregnant women and infants, and later for children up to age 18. Today, Medicaid covers 17.9% of Americans. As it is a state-administered, means-tested program, eligibility criteria vary by state. Individuals need to apply for Medicaid coverage and to re-enroll and recertify annually. As of 2019, more than two-thirds of Medicaid beneficiaries were enrolled in managed care organizations. Children's Health Insurance Program. In 1997, the Children's Health Insurance Program, or CHIP, was created as a public, state-administered program for children in low-income families that earn too much to qualify for Medicaid but that are unlikely to be able to afford private insurance. Today, the program covers 9.6 million children, 5 in some states. It operates as an extension of Medicaid. In other states, it is a separate program. Affordable Care Act. In 2010, the passage of the Patient Protection and Affordable Care Act, or ACA, represented the largest expansion to date of the government's role in financing and regulating healthcare. Components of the law's major coverage expansions, implemented in 2014, included requiring most Americans to obtain health insurance or pay a penalty. The penalty was later removed. Extending coverage for young people by allowing them to remain on their parents' private plans until age 26. Opening health insurance marketplaces, or exchanges, which offer premium subsidies to lower and middle-income individuals. Expanding Medicaid eligibility with the help of federal subsidies, in states that chose this option. The ACA resulted in an estimated 20 million gaining coverage, reducing the share of uninsured adults aged 19 to 64 from 20% in 2010 to 12% in 2018. 6. Role of government. The federal government's responsibilities include setting legislation and national strategies, administering and paying for the Medicare program, Co-funding and setting basic requirements and regulations for the Medicaid program. Co-funding chip. Funding health insurance for federal employees as well as active and past members of the military and their families. Regulating pharmaceutical products and medical devices. Running federal marketplaces for private health insurance. Providing premium subsidies for private marketplace coverage. The federal government has only a negligible role in directly owning and supplying providers, except for the Veterans Health Administration and Indian Health Service. The Act established shared responsibility among government, employers, and individuals for ensuring that all Americans have access to affordable and good quality health insurance. The U.S. Department of Health and Human Services is the federal government's principal agency involved with healthcare services. The states co-fund and administer their CHIP and Medicaid programs according to federal regulations. States set eligibility thresholds, patient cost-sharing requirements, and much of the benefit package. They also help finance health insurance for state employees, regulate private insurance, and license health professionals. Some states also manage health insurance for low-income residents, in addition to Medicaid. Role of public health insurance. In 2017, public spending accounted for 45% of total healthcare spending, or approximately 8% of GDP. Federal spending represented 28% of total healthcare spending. Federal taxes fund public insurance programs, such as Medicare, Medicaid, CHIP, and military health insurance programs, Veterans Health Administration, TRICARE. The Centers for Medicare and Medicaid Services is the largest governmental source of health coverage funding. Medicare is financed through a combination of general federal taxes, a mandatory payroll tax that pays for Part A, hospital insurance, and individual premiums. Medicaid is largely tax-funded, with federal tax revenues representing 2/3, 63%, of costs, and state and local revenues the remainder. 7. The expansion of Medicaid under the ACA was fully funded by the federal government until 2017, after which the federal funding share gradually decreased to 90%. CHIP is funded through matching grants provided by the federal government to states. Most states, 30 in 2018, charge premiums under that program. Role of private health insurance. Spending on private health insurance accounted for 1/3, 34%, of total health expenditures in 2018. Private insurance is the primary health coverage for 2/3 of Americans, 67%. The majority of private insurance, 55%, is employer-sponsored, and a smaller share, 11%, is purchased by individuals from for-profit and non-profit carriers. Most employers contract with private health plans to administer benefits. Most employer plans cover workers and their dependents, and the majority offer a choice of several plans. 8, 9. Both employers and employees typically contribute to premiums. Much less frequently, premiums are fully covered by the employer. The ACA introduced a federal marketplace, healthcare.gov, for purchasing individual primary health insurance or dental coverage through private plans. States can also set up their own marketplaces. More than 1 in 3 Medicare beneficiaries in 2019 opted to receive their coverage through a private Medicare Advantage health plan. 10. Medicaid beneficiaries may receive their benefits through a private managed care organization, which receives capitated, typically risk-adjusted payments from state Medicaid departments. More than two-thirds of Medicaid beneficiaries are enrolled in managed care. Services covered. There is no nationally defined benefit package. Covered services depend on insurance type. Medicare. People enrolled in Medicare are entitled to hospital inpatient care, Part A, which includes hospice and short-term skilled nursing facility care. Medicare Part B covers physician services, durable medical equipment, and home health services. Medicare covers short-term post-acute care, such as rehabilitation services in skilled nursing facilities or in the home, but not long-term care. Part B covers only very limited outpatient prescription drug benefits, including injectables or infused drugs that need to be administered by a medical professional in an office setting. Individuals can purchase private prescription drug coverage, Part D. Coverage for dental and vision services is limited, with most beneficiaries lacking dental coverage. 11. Medicaid. Under federal guidelines, Medicaid covers a broad range of services, including inpatient and outpatient hospital services, long-term care, laboratory and diagnostic services, family planning, nurse midwives, freestanding birth centers, and transportation to medical appointments. States may choose to offer additional benefits, including physical therapy, dental, and vision services. Most states, 39, as of 2018, provide dental coverage. 12. Outpatient prescription drugs are an optional benefit under federal law. However, currently all states provide drug coverage. Private insurance. Benefits in private health plans vary. Employer health coverage usually does not cover dental or vision benefits. 13. The ACA requires individual marketplace and small group market plans, for firms with 50 or fewer employees, to cover 10 categories of essential health benefits. ambulatory patient services, doctor visits, emergency services, hospitalization, maternity and newborn care, mental health services and substance use disorder treatment, prescription drugs, rehabilitative services and devices, laboratory services, preventive and wellness services and chronic disease management, pediatric services, including dental and vision care. Ambulatory patient services, doctor visits, emergency services, hospitalization, maternity and newborn care, mental health services and substance use disorder treatment, prescription drugs, rehabilitative services and devices, laboratory services, preventive and wellness services and chronic disease management, pediatric services, including dental and vision care.